Welcome back to another stock valuation. This time we're going to be doing Lockheed Martin. They have a $95 billion market cap and are selling for $345 a share. This one was a recommendation and it was a great suggestion because not only is it going to come in at a fair value compared to the share price, but it's also going to have a lot of teaching opportunities. So I'm excited to share it with y'all. So what we're going to do is we're going to go over a quick price history and then we're going to take a deep dive into the fundamentals and the financial statements. So let's start with the share price history. So what I have here is a chart of the last 2 years, and you can see it's been a wild ride as a shareholder of Lockheed. So I mean, you went just in a 2-year period, you had an up 15%, you had a down 30%, you had an up 40, another down 15. I don't need to go on. It's been a wild ride. And if you look in the last 3 months, everything was going good. And you had a huge dip here. And so one thing that we're going to keep in mind while we're looking at these financial statements is what could have caused that dip. Is it something to concern us moving forward, or did it create a potential buying opportunity that's still available? So let's get started by looking at the income statement. First up, as always, total revenue, top line item. We always look at this first. We make sure it's not shrinking. It's not shrinking here. It was growing good. It's a little flat line, but that's okay. Still higher than it was a couple years ago. That's all we're going to look at for revenue. It's just a quick check. We don't get a valuation metric from it. All right, next we're going to look at operating income. So this is growing. Love to see this too. So this is a great sign. Operating income is the total revenue minus the cost of goods sold. That would give you gross profit, but you also subtract out all of your operating expenses. So what it actually cost you to operate all the facilities and pay everybody and do the research and development, all of that good stuff. All right, so in Lockheed's case, I'm going to look at operating margin instead of gross margin. In general, you always want to look at one of the margins. And what do I mean by that? You always want to look at gross margin, operating margin, or net income. At least one of them, preferably all three. But usually only one of them is a good way to judge a competitive advantage because each industry is a little bit different. Each company is a little bit different. In Lockheed's case, the way that they classified their expenses, I thought operating margin was the best route. All right, so from a relative standpoint, I like to see the growth. From an absolute standpoint, I would say it's okay. Operating margin, I'd love to see over 20. It's not over 20. Under 10 is a huge concern for me, so we're kind of in an okay range, but that's kind of what I would expect, them being a large weapons and aircraft design and manufacturing company. The next thing we're going to look at is interest payments divided by your operating profit. So this is a way to tell how leveraged a company is, how much it's relying on debt to make money. So if you're spending a lot of your operating income on interest payments, that's just like another tax, and taxes are bad enough as they are. You don't want two taxes. Okay, so as far as the pattern goes, recently this is beautiful. Decreasing, I would say over 20%, or really over 15% is not good. You do not want to be spending 15 to 20% of your operating income in interest payments. Under 10% is good, and that's where they've been recently. They've been as low as 6% recently, so this is a great sign. It means that they're deleveraging, they're relying less and less on debt, and I love to see that. All right, so we have had a great income statement so far. Let's move to our pre-tax income, which is going to be our first valuation metric that we're going to get. There it is. What the hell? Okay, well, this must have been why the stock dipped, right? Anytime you see something like this, you need to dig in further. We know it wasn't a drop in revenue. We know it wasn't some operating expense because we would have seen it in the operating income. It wasn't a debt interest thing, so it's probably going to be an other income. I mean, it's got to be an other income. So real quick, before we get our pre-tax, I'm going to jump to this other income expense. Yep, there it is. $1.4 billion, $1.5 billion in a quarter on other expense. That's not good. At least they get a tax benefit from it, right? All right, well, we'll go back to pre-tax income. So we need to find out what that was to just make sure it's not something that can happen again. If it was a write-off of an asset or a booked loss on something, that's okay. That means it's not going to be a recurring expense, but I still don't like seeing it. All that being said, though, we are going to ignore it for the purpose of this valuation right here, and I'm going to take the sum of these last four right here, the 4 quarters before this terrible quarter. So if I take the sum of those last 4, I get $8.6 billion for the yearly pre-tax income. So that's what I'm going to put here is $8.6 billion. All right, and now we're going to get a growth rate. So the way we get growth rate is we look at about the last 5 years or so and just turn that growth into an annualized growth rate. So what we're going to do is say about 5 years ago, they were at 1.5 billion for the quarter. Now they're about $2 billion for the quarter. Always lean to the conservative side for growth rates. I always say it, but I'll continue to beat this drum because it is probably the best way to step in a trap as far as overvaluing a company, is to just have a super inflated growth number. So always be conservative, because you might be saying, no, you're not at 1.5. You went from 1.4 to 2.2. Just round to make yourself as conservative as possible whenever you're doing growth calculations. All right, so 1.5 to 2 in 5 years. I'm going to do that in the calculator. 2 divided by 1.5 raised to the 1/5 because it was 5 years. And I get 5.9%. So I'm going to round up. I know I just said don't round up, but I like simple sig figs. So 6%. All right, last part of the income statement is going to be our earnings per share. We always use diluted earnings per share, remember. We're going to ignore this one, we already talked about that, and we're going to sum these last 4 before that. So if I sum those last 4, I get 25.51 for our earnings per share, 25.51. So I would say the income statement's okay. The big write-down is not great, and that probably explains that drop in the share price, but I don't think it's going to be a recurring expense, so it's not anything that really worries me. I'm more excited that it might have created a huge buying opportunity, but we'll see that at the end. All right, moving to the balance sheet. First up, total tangible assets. This is everything a company owns, all of its assets, minus the intangibles and goodwill. So things that don't really have a liquidation value, if you will. So what we do with total tangible assets is we are going to get a pre-tax return on tangible assets. And I've talked about this before, but the reason I love this metric is because I think it's very intuitive, and it's how people who don't think about business that often intuitively think about starting a new business. So if you were going to start a new business, you would say, how much money do I have to put up front for the equipment, and how much money am I going to make pre-tax every year? And in your head, what you're doing whenever you say that is you're getting a return on assets. So that's what we're going to do. So our pre-tax income was $8.6 billion, and we divide by the most recent tangible assets, which if you look here is like $38 billion. So I'm just going to divide by 38. And we get 22.6% return on tangible assets. 23%, I'm rounding up. That is outstanding, especially for a company that manufactures big equipment. To be getting 23% on tangible assets, it's a great sign. That's impressive. All right, let's look at inventory. We have never looked at inventory before, but I want to show you something neat that you can keep an eye out for whenever you're looking at companies. Okay, so inventory by itself really does not tell you anything, but for manufacturing companies, inventory is broken down into 3 big categories. It's raw materials, so the stuff that you have on site that you haven't yet turned into finished products or finished goods, which are products that you've finished, that you've completed but are still sitting on your property that haven't been sold yet, and then finally works in progress, which is just what it says. So let's start with raw materials. So raw materials are super interesting because this can tell you how a company is thinking about its future prospects. So if a company is ramping up its raw materials, it usually means it's expecting increased production and it's expecting increased sales. So we really do like to see raw materials increasing, and it is. Look, that's a good sign. So let me talk about products real quick. Work in progress really doesn't tell you much, so you might as well just ignore it. All right, finished goods. If this is flatlined or decreasing, doesn't really tell you much. It's not that big of a deal. But what you want to look out for, and this is the biggest takeaway from this video, even though this company's not doing this, but I really want to point this out. If you see finished goods or finished products increasing significantly, you need to be very scared, because what that usually means is that the company is building up a ton of its finished products and it's sitting in its warehouses on its property. It's not getting sold. And if it's not getting sold, they're not making money. And if they're not making money, you're not going to be a happy shareholder. So just keep that in mind. Going down doesn't tell you that much, and flatline doesn't really tell you that much. You really are just looking for a company that is increasing its finished goods significantly as a big red flag. And this does not trigger a red flag, but I wanted to point that out. All right, let's go to tangible equity per share. So this is, it's negative. Okay. So this is just like we looked at with total tangible assets. And then we subtract out all the liabilities and we take that difference and we divide by the number of shares outstanding. So this just means that they probably have a lot of intangible assets and goodwill. Look, big companies will carry a lot of goodwill and a lot of intangible assets, and I'm not going to ding them for it, but I'm also not going to count it as a positive, even if it is growing, because it's negative. So it's kind of a wash for me on the balance sheet, although I do really like that return on tangible assets. That's nice. Okay, let's go to the cash flow statement. All right, free cash flow. That's the most important thing on the cash flow statement, and some would say the most important thing in all stock valuations. All right, so what we do here is, get an estimate for the free cash flow. I'm going to take the average of the last, 7 quarters. So if I do that, if I take an average of the last 7, I get 1.49. So 1.49 billion, that's a 2. 1.49 billion times 4. And I get 5.96 free cash flow. You know what I'm about to do. Round up. 6 billion free cash flow for a yearly average. Okay, let's move to dividends and buybacks. First off, cash dividends. Okay, this is a great sign. So the company is increasing its dividends on a consistent basis. So one thing to keep in mind, management at a company will almost never increase the dividend unless it knows it can sustain it for a very long period of time. So if it's constantly increasing the dividend, it means it's having a constantly increasing faith in the future prospects of the business. And if management is confident in the future of the business, we're happy as shareholders, usually. So this is a good sign. And next we're going to look at stock buybacks. Are they spending any money buying shares back? So remember, these numbers are going to be negative because it's cash leaving the checking account of the business and being used to either buy back shares or pay dividends. So it's leaving the business, even though it's returning value to shareholders, it's going to be negative. Negative is not bad here. Negative is actually good. So you can see that they've been buying back shares. They took a break during COVID. It looks like they're back at it. That's a good sign. I mean, companies should only buy back shares whenever they think it's undervalued. Not every company does that. Some companies buy back shares because they're trying to prop their stock price up, which is a terrible idea. But if a company really does think their share price is undervalued, buying back shares is a great thing to do. Although I will question, they're getting a great return on assets. I'm surprised that they're sending this much cash flow out in dividends and repurchase, but it is what it is. Let's go to valuation. Let's get a number for them. All right, first up, rule of thumb method, pre-tax income times 10 divided by the number of shares. So we take 8.6 billion, that's the number we got, times 10, divided by 276 million, so divided by 0.276. And we get a target price of $312 per share. Not bad. All right, next one is going to be our Ben-Graham formula from security analysis. So this one is going to be our earnings per share. So 25.51 times 8.5 plus 2 times our growth rate, which was 6%. And we get $523 per share. Awesome. And last but not least is our discounted cash flow, DCF. What we're going to do is put our free cash flow number here. So 6 billion per year, perpetual growth rate. For the perpetual growth rate, you want to pretty much cut your other growth rate in half. Sometimes you're a little more generous than that, but in this case, I'm going to stick to that rule of thumb and just cut it in half. So 3%. And my discount rate is 15%. So I'm going to use 15%. All right, and we get a net present value of $57 billion for the market cap. So what I'm going to do is say 57 billion divided by 0.276, and I get a target price of 206. All right, so our three valuations were a little all over the place. Pre-tax actually came in the closest, which is rare, but that works. Earnings per share formula, high, that's usually the case. And the DCF, that worries me a little bit. I have some pretty serious questions about the DCF. Why is their free cash flow so much lower than their pre-tax income? Usually it's a little bit lower, but to have it be close to 40-50% lower is raising some red flags. Usually a big discrepancy there means that the company is spending a lot more on CapEx than they're depreciating. And I'm usually not okay with that unless I'm seeing a lot of growth, and we're not seeing a lot of growth. So that would be some of the questions I had as far as the cash flow statement and the free cash flow goes. All in all, look at our share price. We came in almost dead on to what it's selling for right now. So I would say Lockheed is selling for a pretty fair price. I wouldn't say a discount, but there's nothing wrong with selling at a fair price. I think there's a lot of upside, and if they turn that free cash flow around and get it close to the pre-tax income, I think that it would be selling at a discount. So those are numbers I'll be watching as far as future quarterly reports. I'm not going to be buying them yet, but I'm going to be keeping a close eye on them. I hope you learned something. I hope you enjoyed the video. If you did, please like and subscribe, and I will see you next time.